Hello traders, Gary Wagner with the Gold Forecast here. It is Aloha Friday here on the islands of Oahu. It is December the 10th, about 1/2 hour prior to the close for the weekend, and this is the Gold Forecast's weekend review. Gold currently trading close to unchanged, down about 90 cents, trading at 1386. 1385. On today's report, we will look at the weekend review. We will look at support and resistance levels. We will look at our Henkin chart, and we will also take a look at the position that we entered yesterday. That's all here on today's daily report. Traders, as far as the week overall is concerned, we did have a lower week. We are looking at a weekly candlestick chart. Each candle represents 1 week of trading activity. And as you can see, we have a similar pattern forming to the pattern that we saw just back a few weeks ago when we got this dark cloud cover. I'm not paying too much attention to it without follow through or confirmation. The one thing that I am noticing on the weekly chart is that this is our Andrews pitchfork, and it has moved above this 50% range and does seem to be tracking in this channel right in here. We'll see if it continues and wants to move higher. Of course, this is our daily candlestick chart, and I did want to review the week a little bit. For traders who have been with us for some time, you recall we did enter a long position, and this long position that we entered was based, this is back almost 3 weeks ago, based on this Three River Morning Star here, and we did enter that position. Now, the market itself did tend to meander. In other words, it took off straight, but it consolidated and it formed a lower base as it came down here. However, it did start trading higher, and this week, we saw this engulfing bearish develop just a few days ago. As soon as we saw this pattern develop, I recommended that we take our stops pretty much to the market. We moved them up to 1395, and we therefore pulled profits. At the beginning of this week, we bought in 1354, and we sold out at 1395, a $41 profit. Now, the market did in fact come down. It came down lower, and here's what I'm finding interesting. This 50% retracement level, this 1372, I happen to think is a very, very critical level. It's a 50% retracement when we look at this overall move here. And what we're seeing is a pattern known as tower bottoms. Tower bottoms are similar to tweezer bottoms. Tweezer bottoms are when you have 2 days that have identical lows. This would be called a matching low to the Western technician, and it does lend itself to, I believe, some superlative support in this area. Of course, yesterday, based upon this inverted hammer and the fact that we had these matching lows here, I went ahead and made a recommendation to enter a position from the long side. Traders that took that call are in at roughly 1385. So the area or the target that we came in is right in the same area that it's trading at now. Our stops are at 1345 on a protective stop. So as far as the week itself goes, we were able to pull profits here and then re-enter a long position just yesterday. We'll have to see how all of this pans out next week. In terms of support, I see superlative support down here at 1372. That's a number we've been talking about. Now, this is a 30-minute candlestick chart, and the reason I'm pulling it up is I think that you can see the significant double bottom that we got right in here as it found support. The other interesting thing to note is these lows were both capped by long-legged dojis in the 30-minute chart. That tells me that there's significant buying that comes into the market, that buy the dip mentality, that safe haven hunting, but most importantly, there is bargain hunting going on. When these markets hit these lows, there are plenty of buyers that wish to enter the market at this area and continue to trade this market from the long side. Traders, we are looking at our candlestick chart. This is a daily candlestick chart with some of our Elliott wave count put into it. I'm going to turn it into a Henkin or an average chart in a second. But my feeling right now is that this fifth wave that we're looking at is probably going to be a complex wave, and it's probably going to be, at least in terms of a minor wave within it, at least a 3 count, if not a 5 count. In other words, as we came down, this is our wave 4. Our wave 5 starts here. So I'm looking for it to come and work something like that. That's the anticipation, and that is what I would be looking for it to do itself. Now, in terms of the Henkin chart, let me go ahead and put that up. I'm just going to transform it. And as you know, we introduced this type of chart last week. It's an average chart, so it's always going to lag behind something like candlesticks or Fibonacci, but it gives us a good, clear picture. It kind of removes the clutter. The one thing that I'm noticing right now is what you want to see within a Henkin chart itself. Of course, as the market moves up, you want to see these candle sizes get larger, and of course you want to see the absence of a lower tail here or wick, meaning right in here. Once you start getting those wicks as you got right here, what that tells you is that the trend itself is weakening, and obviously, as we can see, in fact, it did here and then it came down. In the same way, the market has moved up. You can see that weakening trend candle. That's right in here. This is that long selling day right in here. But what we are noticing is that the body sizes between these last 3 days has been getting smaller. And what that tells us is that the bearish sentiment is slowly diminishing and losing steam within the market itself. Traders, as you know, we did recommend entering a small position in the marketplace yesterday. Traders got in roughly a dollar below this, around 13.85. Recommendation, maintain that position. Recommendation, stop. 13.45, maintain that position. We are looking at a daily Henkin chart, and in which I have put not only Andrew's pitchfork, but what we call Fibonacci extensions. The extensions will allow us to chart potential resistance areas that we feel the market has to overcome if, in fact, it's going to go and reach new highs. In other words, what are our targets right now? First of all, we need to see this market consolidate, and we need to see this market, most importantly, be able to form a base down here. I think that this double low, this 1372, I think that that's going to hold. I think that this 1380 level, this is going to become support because we've had some good considerable closes above that. Now, the next target that we have to hit in terms of the big picture is to take it over 1400. In terms of a psychological level, that's always pretty huge. However, if we draw a line across here, you'll see that it really doesn't match up very, very well in terms of technical indicators, only psychological indicators, because our real next target of resistance, in my opinion, is going to be around 1418. And then if we can take out these highs at 1424, I believe our next target is going to be 1442. 1442 is going to be where I think we will find some major resistance if, in fact, this market can continue to move up this channel. Traders, this has been another great week for us. We had a very, very good winning trade. We've entered another one. We'll have to see how the market pans out. I do expect it to start to begin to get a little choppy and quiet as we go into the holiday season, and we'll have to see how that pans out. This has been Gary Wagner, wishing you, as always, good trading, and we will talk to you on Sunday for another daily review. Bye-bye.